Hey gang, it's Geoff Schmidt and welcome to our Tuesday live stream. Joining me today is our producer Jill. She will be going through all of the questions that you've sent in and all the questions that you're going to ask on the phone or on the call. I guess it would be on the chat box. Just usual protocol. Let me just go through the disclaimer. Many of the questions we receive are nuanced. We do our best to answer them, but our responses are meant to be directional, not exact. Your situation may be different and require different advice, so look at this information as educational. We haven't had the chance to speak to you one-on-one, so if you do need the advice on a very specific situation, we recommend that you talk to a professional who is familiar with your specific situation. All right, now that we got that out of the way, why don't we jump into it? Jill, why don't we go through the questions and then you can give the group the instructions for the live stream.
All right, great. Welcome, everyone. So we have a number of questions that were emailed in, and so we will be mixing those in with those questions that are brought to us live. So we do encourage you, please do put your questions into the chat box. Tonight, we will be addressing only questions pertaining to Social Security. So do bring us all those questions. We're looking forward to answering them. All right. So Geoff, I want to start with a question that came in by email from Jeffrey. So that will be our first question tonight. And he says, I've been told by 2 Social Security Administration representatives that a surviving spouse receives only the deceased spouse's primary insurance amount, not the higher benefit the deceased was actually receiving after claiming at age 70 with full delayed retirement credits. My wife's sister has told her the same thing. Because this has significant financial implications for us, I need to be certain. Under current Social Security rules, does a surviving spouse receive the deceased spouse's actual benefit at the time of death, including delayed retirement credits, or only the primary insurance amount? And what official Social Security documentation clearly confirms the correct answer?
Well, we might as well jump right into it. Let's not ease into those questions. Let's start off with one that 2 people from Social Security and his partner's spouse have a different view than what I've been saying. So I will say that since I knew this question was coming and I knew that you were looking for proof, Jeffrey, I did put a link to what I'm about to say in the description below. So the answer is your spouse, your surviving spouse, the survivor, receives your Social Security benefit if you had claimed your benefit. And in this case, I think you're talking about claiming your benefit at age 70 or past full retirement age, in which case it would be 124%. That's haircut by the age of your spouse. So if your spouse is under her own full retirement age, then that amount would be reduced. Now, I will tell you that since I knew this question was coming and it comes up all of the time, it took me over an hour to find the exact document which outlines the answer. Because if you go onto the Social Security website, it's very vague about this point. So the answer is in the description below. Click it. It'll take you right to the page, and it'll say very clearly that if you delay taking Social Security, your survivor gets the higher benefit, reduced for their own age. And it'll lay out some other caveats as well, but nothing that is really relevant here. The one point that, and this is where the Social Security Administration people that you're talking to might be confused, is that there's the widow benefit, which is the one everybody's thinking about when they're thinking about the survivor benefit. But there's also the children's benefit, and that's based on the full retirement age benefit. It's a reduction of the full retirement age benefit. It's not the actual benefit that you as the primary insured claim. But the widow benefit is based on the amount that you were receiving or you would have received at the time of your passing.
All right, great. All right. So don't forget to check. Where is it? It's in the comments.
It's in the description below, and it says something like survivor benefit link. Just click it. It'll take you right to it. The other information that the SSA has on their website is useful, but it's not specific. It just talks in big picture terms of why the survivor benefit's important, but it doesn't get into the actual math. The link that I put in the description below gets into the actual math.
All right, great. Thank you for that resource. Jim is asking, I'm planning to start Social Security at age 68 after my full retirement age of 66 years and 10 months. My wife will start claiming spousal benefits when I begin, as she will turn 67 just 5 days before me. I understand that waiting past full retirement age increases benefits by about 8% per year. My question is this 8% increase calculated before or after the annual cost of living adjustment? In other words, do I receive the COLA for the first year, then the 8% increase, or is the 8% applied first and then COLA added, or something else entirely?
Yeah, the math works out the same whether you get the cost of living adjustment plus 8% or 8% plus the cost of living adjustment. And let's just use an example. The cost of living adjustment for 2026 is 2.8%. And if you waited the extra year, you get 8%. 2.8 plus 8 is 10.8%. That would be the size of your increase for waiting. You get the COLA adjustment plus the benefit of waiting, 8% of the full retirement age benefit for every year that you wait past age 67 all the way up to age 70.
Okay, BR549 is asking, if I start taking Social Security at 66 years old, when I go to the Social Security site to start the process of collecting Social Security, can I dictate when I want my first check to start? Say I want my first check in January the following year if I start the process in September.
Yep. So you should start 4 months before you want to actually start receiving Social Security. The payment is paid in arrears. So if you start receiving Social Security in January, that would be for December. And if you receive your payment in February, that would be for January. So just know that's the mechanic. And this is important because the longer you wait, the larger your Social Security payment. And 1 month could make a difference, especially in the later part of the claiming period. We just talked about waiting until you're 67 and picking up an extra 8% per year plus the cost of living adjustment. Well, 8% per year is 2/3% per month for the rest of your life. And so it does make a difference if you want that extra month over the course of your life. It is important.
All right. Karen P66. I'm thinking maybe you meant to put a different year. So if you are on here, if you might want to adjust this, it does say, do you think Social Security will change before 1934?
So it's 2034 is what she's asking. And I think the question is
Social Security age and amounts will change. She just put a clarifying question. Do you think Social Security age and amounts will change before 2034?
I think that there will be. This is Geoff Schmidt speaking. The versus anything that's published, but if you think about this logically, there have been a dozen major amendments to Social Security. Many of you who've watched this live stream have heard me cite the fact that in 1983, the Social Security Trust was 2 months from running out of money, and an amendment was put in place, one which increased the FICA contribution, and that started immediately, and the other increased the full retirement age from 65 to 67, but that started 20 years in advance. So anybody between 1983 and and 2000 didn't have to really worry about the adjustment being made while they were entering retirement. My strong guess, and I would say probably more than a guess, educated opinion, is that you don't want to be in a situation, the government doesn't want to be in a situation where they catch anybody off guard. You don't want to be in a situation where you're going into retirement and your full retirement age is age 67. And as you're reaching age 67, they say, you know what, guess what? Surprise, it's 69. I think that is highly, highly unlikely. I think that the mechanism will be something similar to the amendment in 1983. And that is they'll probably raise the FICA contribution 0.2%, something along those lines, maybe 0.5%, maybe a little bit more. And they'll make another adjustment like full retirement age. But it won't, I think it would be highly unlikely that anybody who's approaching the time to collect Social Security will have the rug pulled out from underneath it. I think that it'll happen gradually, just like it did in 1983, with the exception of the increase in FICA. Now, there are other ways to increase FICA. There's been a discussion about the donut, where you right now you can the cap on Social Security is on the first $184,000, $184,500, I believe, and then the concept of the donut is that would be locked, and then there would be this big gap where no one would pay anything into Social Security until it hits another threshold at say 400,000 or 500,000. I also think that's unlikely, but I think it's possible, I suppose. But there are a lot of combinations in there where the FICA contribution can go up, and that FICA contribution is what stops the haircut from happening in 2034. And I think, to be candid, I think the politicians would be career suicide to send 57 million people into a situation where their Social Security payment is going to be cut. So I think it's highly, highly likely that there's going to be something which increases the tax going in, so that the people in retirement are protected. The exact mechanism, whether it's everybody pays a little bit more, or there's a donut, or maybe the progressive nature of Social Security continues, and right now you get almost everything that you contribute back if you earn a certain amount of money over your life, and then that becomes smaller and smaller the more you earn over your life. Well, you could continue to push that out too. By the way, if anybody wants to know how all of this works, I did put a link in here, which I will share with you, to my course, Social Security Simplified. But more importantly, and really for this group, the information that I'm using right now is on a cheat sheet. And in that cheat sheet, you can just go to holyschmidt.com/quick guide. It looks exactly like that picture in the upper right-hand corner. And if you want to download your free cheat sheet, go to holyschmidt.com/quick guide. And a lot of the data that we're talking about here is actually already in there, pre-populated for 2026. I'll leave that up for a few minutes so that people can write it down, and then you can check it later.
And I'll just balance it right on my head.
It's sort of just move over to your right.
Yeah.
That's it.
All right. Good. Got it. All right. Carl TBD 4682 is asking, my full retirement age was 66 and 8 months, which was January 2025. I delayed to January 2026. What year of eligibility index factors do I use?
If I understand your question, if you're talking about indexing factors, the indexing factors that you use are locked in when you turn age 62. And for those that don't know what indexing factors are, these are the factors that bring your historical payments into current dollars. And from the time you start working to the time you're age 59, these factors are moving effectively, because the longer time goes on, the more valuable that dollar you earned back in 1983 becomes in today's dollars. The example I use is, if you earned $10,000 in 1983, the indexing factor would be about 3.5. And so that would be $35,000. That would be the value of the indexing factor in 2025, more or less. And so, but once you reach age 62, the indexing factors don't calculate anymore. And actually, once you reach age 60 and beyond, instead of having your historical earnings brought forward, your 1983 earnings of 10,000 brought forward to 35,000, using an indexing factor of 3.5, once you reach age 60, they just use a continuous indexing factor of 1.0. So it stops at age 60 and it's locked in at age 62, the first year that you can take Social Security.
Okay, so Keith is asking, I turned 62 April 3rd. When can I apply, and when will my first deposit hit my checking account? I called and Social Security said I can't apply before January 3rd, 26. Is this true?
Technically, it's December 3rd, 25, but the SSA, you can apply as late as, or as early as 4 months in advance, but 3 months in advance is when most people do apply. You can do it in 2 months. I wouldn't push it past January 3rd. As far as when you get paid, every payment is in arrears. So if you are eligible to collect from April 3rd onward, your payment will be in May for the month of April.
All right. So Tim is asking, where can I find a clear, easy to understand explanation of the claim that there will be no tax on Social Security in 2026? I've been told this is not accurate and would like to understand what the current law actually says. How Social Security benefits are taxed today, and what, if anything, would need to change legally for that claim to become true.
So there are, if you step back and you look at any change, any big change to Social Security, in order to have your Social Security receive tax-free, you'd have to have an amendment to the Social Securities Act of 1935. And that was what happened in 1983, by the way. And remember, I said that there were a dozen big changes to the Social Security Act. Well, that happened in 1983, and the taxation of Social Security began after that amendment. The claim that no tax on Social Security is a political claim based partially in fact and partially not. So in order to actually just go wholesale, you know what, we're gonna get rid of all tax on Social Security, it would be really hard, because you have to have an amendment to the Social Securities Act. And so whether you're receiving Social Security or not, there was effectively a makeshift solution to the political claim. And that is, okay, we have a population of people that earn so much, and we know that, say, 80% of them don't pay tax on Social Security because they just don't earn enough money. How do we make that 90% or 93%? That might be the number. We give them a deduction, an additional deduction for people age 65 and older, and that's $6,000 for an individual, and $12,000 for a couple. And that kicks it over so that a much higher percentage of people don't actually pay tax on Social Security. But it's not in the Social Securities Act. It's not an amendment to the 1935 Act. It's a separate deduction for people age 65 and older. And so whether you're claiming Social Security at age 65 or not, you still get the deduction. So if you want to know more about how it impacts you, you have to either talk to your tax accountant, or if you're like me and you do your own taxes, hop onto TurboTax or whatever you like to use, and it'll lay it out pretty easily for you.
All right, great. So Pete is asking, my wife retired in 2022 and currently receives about $1,200 per month in Social Security benefits. I plan to retire in March 2026 and expect to receive about $2,700 per month. Once I begin collecting, is there anything that can be done to increase my wife's Social Security benefit?
Okay, so I'm going to make the assumption that in 2026, you're at full retirement age. And your question is, my wife gets $1,200 a month now, but the spousal benefit is $1,350 per month at my own full retirement age. And by the way, the spousal benefit only comes into play once the primary insured files for his or her own Social Security. You can't file for a spousal benefit if there's no primary benefit being drawn. So if you take your primary benefit in 2026 of $2,700, that means that had your wife not taken Social Security, her own Social Security early, and she was at full retirement age, she could have taken $1,350. If you had filed earlier, she still could have taken $1,350 at her full retirement age, because the spousal benefit is always based on the age of the spouse, not on the age of the primary insured. And at the spouse's own full retirement age, they get half of the primary insurance amount if they wait until full retirement age. But the caveat is, if you have your own Social Security and you start drawing early, you can't both draw early and get a full spousal benefit, because the mathematicians and the government figured out that they would lose a lot of money that way. Mm-hmm. So if you were supposed to get $1,350 in 2026, and you end up, if that would have been, say, well, let's use the amount that you have locked in now. You have $1,200 locked in. That was locked in 2022. If there's a difference between the two, if there was a difference between the spousal benefit and your wife's own primary insurance amount, that difference would be the only thing that continues to grow. So unfortunately, in 2022, she locked in $1,200 of the amount, and the balance continues to grow. It's a concept called dual entitlement. I have a video on it. If you want to check it out, just go on the channel and look for the video on a two-income family and how that impacts Social Security. In fact, look up the term dual income or two income, and it'll pop right up.
Okay, great resource. All right, Cheryl is asking, I turned 70 this month and will begin taking Social Security. Currently, I have auto deductions for Medicare. Do I need to notify Medicare, or will they handle the change?
Sorry, would you repeat that question one more time?
I turned 70 this month and will begin taking Social Security. Currently, I have auto deductions for Medicare. Do I need to notify Medicare, or will they handle the change?
So auto deductions from your checking account is what you're saying. Because if you haven't taken Social Security yet, they're not taking your Part B from Social Security. They must be taking it from your checking account. I would notify them. I wouldn't. They'll catch it eventually, but I wouldn't. The Part B payment is $202.90 a month. If you want to, if you don't want to be in a position where you have to go chasing a couple of months worth of part of your 2 months with your Medicare Part B payment. So let them know that you are going to be taking Social Security when you turn 70. And I suppose the worst that would happen is that there's 1 month where you both have it deducted and taken out of your Social Security check, but it's just better to let them know.
Okay. Finding Ariel is asking, been receiving Social Security retirement benefits for 2 years and on original Medicare. Just found out Social Security has incorrect birth year for me, making me 1 year older than I really am. How do I correct this?
If they think you're 1 year older than you really are, you may have been overpaid for a while. You definitely need to get a hold of someone at the Social Security Administration and let them know, because the worst thing, you don't want them to actually figure it out 5 years from now and you get a bill for $10,000 or $20,000. So talk to the SSA. You can, and this one you might have to do in person, to be completely candid, because if your birth year is wrong, that's not one of those things that happens normally. And so in order to fix it, you'll probably need human intervention. And gang, by the way, when this sort of thing does happen, it's a lot of times it's because the information that the SSA has is been carried over from earlier on. And let me just draw a timeline here of the modernization of Social Security for those that really care. If you went back into the 80s and you had this conversation, you could make a phone call to the Social Security Administration. You get a real human being. You get a real human being in about 5 minutes. They'd pull out their 3x5 card. They'd see, oh yes, I see your birth year is it's 1948, not 1947. Scratch it out, and then that would be the end of it. But somewhere along the way, they had to get all of that information into this new thing called a computer. And the Social Security Administration was much slower at adopting technology than a lot of private enterprises. So the modernization of Social Security really happened in the 80s and 90s, and they were keying in this information from 3x5 cards, from sheets of paper, from microfiche, any and all locations where this information existed. They were putting it in manually into the computer. And then eventually the systems sort of caught up, but not really. And so when you hear about this big push to modernize Social Security, what they're talking about is the systems are still 10, 15 years behind modern technology. And when they're talking about AI isn't particularly, I mean, for those of you that use it, you'll know that it's great, but it's not particularly mystical. It's just a better system than what was in place before, in many regards anyways. Sometimes it's actually quite frustrating. But the point is, if you have a situation where that 3x5 card, they never scratched at the right birth year, the wrong birth year, and put in the new birth year, or it got transcribed incorrectly back in the day, you do need to let them know, because two reasons. One, it's the right thing to do, but two, they do talk with the IRS, and eventually there will be a situation where somebody's gonna have to reconcile something somewhere. But unfortunately, I think this one you need to actually do by hand. So give them a call, and you'll probably have to wait on the phone for a while, but eventually you'll get through.
Okay. Jeff is asking, does K1 income from real estate partnerships count as earnings for Social Security purposes and potentially affect your benefits?
Yeah, so K1 is, for those of you that don't know what a K1 is, it's a tax document, and you get it at the end of the year usually, and you use it with your tax return. It's like a 1099 or a W-2. It's a form of a tax document, but it's for partners in a partnership. And there are basically two types of partners in a partnership. One is a general partner or a managing partner, and basically that person runs the business. And so their K1 is going to could reflect the income they have from actually doing the job. And they might have a separate K1 from earnings from the company that are unrelated to earnings from the job, but just dividends that they're effectively paying to all the partners. If your K-1 is for work done as an employee or as an owner of the company, that will have an effect on your Social Security. That is the threshold when you're talking the earnings threshold. If you're talking about earnings, or that's what I'm assuming you're talking about. If the K-1 is just a partnership's share of income, but you have no active management of the business, you're called limited partner. In that instance, it won't have an effect on the earnings limit for the year. So if you're working in the company, then check to make sure that the amount that you're looking at is for performance of the company and not your personal compensation. If it isn't for your personal compensation, then you're okay. If you're a limited partner, in all cases, you're okay. It won't affect your earnings limit.
Finding Ariel had a follow-up question. She had asked about the incorrect birth year, and she is asking, where did her follow-up just go? Oh, I think it might have just gotten erased.
Ariel?
Hmm?
You say you're trying to find Ariel? Is that what you're saying?
Oh, her name. Well, that's her name,
Yeah.
but her question seems to not be here. She might have taken that off.
Maybe
Okay.
put it back in, and we'll catch it when you put it back.
Yeah. Okay. So let's take Katie's question. I have a Social Security account and plan to start collecting benefits later this year. I've heard that I should apply about 4 months in advance. What documents will I need to complete my application, and can the entire process be done online?
The entire process can be done online, and the documents are pretty straightforward. You'll need your Social Security number if you're working, your W-2. If you aren't working, a copy of your last W-2 so that you can reconcile who you are. You won't need to provide your birth certificate unless they ask. You will need to provide your birthday, but most of the information that they're going to require, you should either have in your head or at your fingertips. Now, if there's a situation where there's a problem with your information, and let me give you an example of problem with your information. Let's just say that somebody somehow got a hold of your Social Security number and they used it for employment. Now there's some confusion as to the information that they have. Then they may require some additional documentation. That happens from time to time. I will tell you that it would be highly, highly unlikely that what people worry about in that situation actually occurs, and that that's the person who is using your Social Security number actually is drawing your Social Security. That rarely happens. I've never actually heard of that happening. Instead, they're using it for employment, but it does create a problem for you that may need additional documentation. So apply as early as you can if there's any, and the documentation is exactly what I just told you. And if there are any problems, the SSA will let you know, but you can do it all online. You can do it all in about 10 minutes.
Okay, Finding Ariel has re-put in her follow-up question. If Social Security entered the incorrect birth year, do I have any recourse if they want to pay back?
Probably not, but you can ask them to. Right now, the Social Security Administration is pretty harsh in terms of their payback period. It used to be very harsh, but then there was a reconsideration of the harshness level, and so at one point it was 50% of what you owe out of every check until you pay it back. Now it's a much smaller amount, and I think you could probably negotiate that to pay it back over years instead of months if necessary. So, but you should talk to the SSA and get this straightened out, because you don't want to be in a situation 5 years from now when the IRS says, well, we've got this birth year, and the Social Security Administration says, well, we've got this birth year, and you get a letter in the mail and asking for clarification. And so it's just better to deal with it honestly, straightforward, and ask them to forgive it. Although I don't think that you will, if they gave you the benefit of an extra year, I honestly don't think you're going to get that going forward. And I think that they probably won't let you keep what you've received, that differential. But you can first ask them for basically a hardship waiver. And if they say no to that, then ask them to spread it out as long as possible.
Okay, so Deborah Smith is asking, I am 73 years old and had planned to draw Social Security next year. I just got laid off this week. I also had an HSA. What should I do next?
Sorry. Would you repeat that?
Yeah. I am 73 years old and had planned to draw Social Security next year. I just got laid off this week. I also had an HSA. What should I do next?
Deborah, if you're 73 years old, you should be drawing Social Security 3 years ago. The maximum your Social Security payment can grow is through to age 70. And so the first thing you do is, if that's not a typo, if you meant to say 63, then that's a little bit different. But if you're 73, the first thing you should do is apply for your Social Security payment pronto, because you've missed 3 years worth of Social Security payments. And so the second question is about the HSA.
Yeah, she just said that she also has an HSA. She's wondering, since she just got laid off, what should she be doing now?
Well, the HSA really affects your Medicare rather than Social Security. So it has nothing to do with Social Security, other than the fact that it's a nice thing to have. If you have an HSA in place, your contributions to the HSA should stop 6 months before you apply for Medicare, 6 months before you apply for Medicare. And so therefore, if you've just been laid off, you're going to be applying for Medicare right now. I'm assuming you're working for a larger company of 20 or more employees, and therefore you haven't had to draw on Medicare. But your contributions to your HSA account are one wonderful thing, but once you start taking Medicare, you can't contribute to your HSA account anymore. In fact, 6 months before you apply, you technically should stop. So I'll tell you what will probably happen now. I think as soon as you contact Medicare, they're going to tell you that you can't contribute to your HSA account anymore. But outside of that, the very first thing you should do at age 73 is start collecting your Social Security payment, like now, because you're losing out every day you wait.
Okay. David is asking, if my spouse claims her own Social Security retirement benefit 12 months before her full retirement age of 67, she was born in 1960, how would that early filing affect the survivor benefit she could receive if I pass away?
So other than the fact that the spousal benefit and the survivor benefit start with an S, they are related. And this is one of the ironic things about Social Security. People think that the survivor benefit and the spousal benefit, because they go to the same person, have some sort of correlation with one another. You can't draw a survivor benefit and a spousal benefit at the same time. And the fact is, once your partner passes, you can't draw a spousal benefit at all because you're now a survivor. So the survivor benefit, the rules around the survivor benefit are different than the rules around the spousal benefit. The survivor benefit is available to you, and it's based on the age of the deceased, the amount that they were receiving, if you recall the conversation we had earlier, where I had to post a link in the description below because two people at the SSA said that the survivor benefit ended at full retirement age. It didn't continue to grow at when the deceased full retirement age. The survivor benefit is a benefit that you assume once your partner passes away, and the longer they wait, the larger the benefit it is to you up until their own age 70. That benefit is haircut by the age that you claim the survivor benefit. And if you look at that guide in the upper right-hand corner and you download it, go to holyschmidt.com/quick guide, you'll see 3 columns. You'll see a column for age-based reductions and increases for the primary insured. That's that thing on the far left. You'll see one for the spouse, and that's the second to left column, and the one on the far right, on the right is the survivor column, and that's the discount. And you'll see that all of them are at 100% at age 67, or the spousal benefit, the full spousal benefit at age 67, assuming the full retirement age is age 67. So the survivor benefit is based on the age of the deceased, not your age, and it's not a spousal benefit. It's your assumption of your partner's Social Security benefit, haircut or not, depending on your own age.
All right, great. Keep putting your questions into the chat box. And also, we still have many, many more questions through email as well. Tom is asking, I plan to retire at 64 or 65, but delay claiming Social Security until age 70. How can I estimate what my monthly benefit will be when I start collecting?
So currently they're age 64. Is that right?
I plan to retire at age 64 or 65, but delay claiming Social Security until age 70.
All right. So when you reach age 64 or 65, the SSA assumes that your earnings are going to continue at their current level until you claim. So all of those estimates you see on the SSA website assume that you work until the month before you start claiming Social Security. If you're looking at this age 70 estimate, it assumes that you're earning what you're earning now until age 69 and 11 months, basically. And there is a way to manually calculate it. It's not particularly difficult, but it is a bit time consuming. And so you can do it, and it involves basically going onto the SSA website, downloading your historical earnings, which are already indexed to today's dollars, and then doing something with those, putting those through a couple of different formulas. I'll put a link in the description below to a video I have on this when this live stream's over, so you can calculate your own Social Security benefit. But you're not going to get an accurate number if you're going to wait until age 70, if you retire at age 64, unless you happen to have 35 years of nearly identical earnings to what you would have had from age 64 to age 70, because the SSA takes your best 35 years and uses that as the basis for your payment. And so since you won't have higher earnings from age 64 onwards, it's going to take your early years, some of your earlier years, which were probably lower earning years. But I'll put a link in the description below so you can calculate it yourself, but you gotta wait until the live stream's over so I can get it to you.
All right. So Joe Bonchi has a question in relation to Deborah Smith's question about that she's going to be starting Social Security in her 70s. And so he's asking if the woman who's 73 files this week, how far back will she get retro pay from Social Security?
Yeah, so the SSA is not really good with this. I think you can go back a year but I think beyond that, you're probably going to be stuck. It is a discussion. I mean, it's such a rare instance, to be candid, that it's something you want to check with the SSA on, because it really doesn't happen, because people, when they reach 70, they know that they can't grow their payment anymore. So speak to the SSA on that particular point, and see what they have to say.
All right, Scott's asking, I plan to retire in 2026 at age 60 and delay claiming Social Security until age 70. My current Social Security statement assumes I will continue earning my current salary per year until retirement, which will not be the case once I stop working. How can I get an accurate estimate of my Social Security benefit based on my actual retirement plans rather than the Social Security's default income assumptions?
I think we just answered this question from a different person, and the answer was you can't really get an accurate estimate if you have a lot of variability in your earnings. If your early years are low earning years and your latter years are high earning years, especially if you have big earnings years over the last 4 or 5 years, and they assume that goes from age 60 to age 70, it's not going to be an accurate reflection of your payment. You can calculate it yourself. That's the only thing you can do. And if you're age 60, you're at a point now where you actually should be able to do this. Go to My Social Security on the SSA website and get your earnings history indexed to today's dollars, and then look in the description below tomorrow, and I'll have a video out there that I filmed on how to calculate your own Social Security payment.
All right. So Liz is asking, if a person applied recently for Social Security benefits and he finds a job, can he withdraw the application?
You can, up to 12 months. So there is, yes, you can withdraw the application within the first 12 months of claiming Social Security. You have to write a check and pay back what you've received from the Social Security Administration, and it can continue to grow. You can also tell the Social Security Administration that you now have a job if it's beyond this point, and to not give you your payment or reduce your payment depending on the amount that you're receiving from your job and the earnings thresholds. Somebody asked me one time, what's the difference? Whether I continued to wait, or if I took Social Security but then told the SSA that I now have a job and to withhold my payment. Or worse yet, I didn't tell them and they sent me a bill a few years later saying that I owed them a bunch of money, and that every time I continued to earn money, I had to return payments back to the SSA for my entire working career. Technically, the minute it goes back, it gets put back in the pool and gets recalculated. But I would say that if you're within the 12-month window, your best bet is to let them know that you now have a job, and then you will have to return the money that you received from them, and you can continue to grow just like you'd never drawn Social Security at all.
All right, great. Greg is now asking, I plan to retire in May 2027 at age 65 and a half. At that time, I expect to have a significant amount combined in my IRA and 401k. I'm trying to decide whether it makes more sense to start Social Security at retirement or to bridge the gap to full retirement age 67 using my retirement savings. Is it ever advantageous to claim Social Security early and invest those benefits, or does waiting until full retirement age generally produce a better outcome?
So this is one of those hot button questions that people are very passionate about. And I'll make the comment that I usually make when someone says this, which is, if you're going to take the funds early and invest them and then turn around and draw from your investments, you're just taking Social Security early and using it. However, people respond with, yes, but I'm getting a higher return on my investments. and you're still taking Social Security and using it. You're just taking it out the other end. But the one element that nobody ever talks about, and this is super important, and this is why I can't answer your question directly, is risk. Now, a lot of you know that I spent 25 years in the financial services industry on Wall Street in New York, and that's what I did before I came here. And one of the first things that people on Wall Street do is that they assess the risk of an investment, or they assess the risk of the situation. In fact, big banks have big risk departments, and all they do is they obsess over what could go wrong, what could go wrong with investment, what could go wrong with the regulation, whatever that case may be. But if this was 2007, let's just say, and you made the decision, I'm going to put all of my money into all of my Social Security into an IRA or a 401k. When 2008 happened, the market dropped a ridiculous amount, and it didn't recover till 2013. That's the real risk that you're looking at here. What's the risk that you're willing to assume in order to take the money and invest it or wait? So on the one hand, if you're willing to assume the risk, well, it might make sense because you could actually have outsized returns. But on the other hand, your growth is very, very much mapped out in front of you. You know exactly what it's going to be. And if you go and you download the Social Security Quick Guide, you'll see it laid out right in front of you. And so it's all about the risk. If you're going to take a lot of risks with the funds, well, some people are okay with that. Personally, I wouldn't be, but some people are okay with that. So I would say for a lot of people, they would rather just have the certainty of the cash flow later, knowing exactly what it's going to be. And in that regard, they let their cash flow payment grow. But just like anything with Social Security, you have different choices. Are you choosing to maximize the payment? Are you choosing to protect a loved one? Are you choosing to enjoy life now because you know that you're not going to be able to enjoy life later, or you want to plan for a big event later, so you want to get the biggest possible payment, or you just need the money? A lot of it depends on what your personal goals are. So that's a long-winded answer of saying I can't give you specific advice. Remember the disclaimer at the beginning of this live stream that this particular question actually is a really good reason why that disclaimer is there. Every situation is different. Yours might be different than your neighbor's. Even if you both work the same job, make the same amount of money, have the same amount of money in savings, you might have different obligations, or you just have different goals. So I wish I could give you a better answer, but I think the best thing for you to do is talk to someone who knows your situation specifically, talk to a financial planner, and talk to one who's a fiduciary, so that they don't really have anyone's best interest but yours at heart.
All right, Dave is asking, I plan on claiming Social Security at 70. What happens if I die before that age? Can my wife still claim my benefit?
Assuming that she's been your wife for more than 9 months, yes. The survivor benefit basically allows your Social Security payment to transfer to her at the time that you became deceased. And so if you, and there's a very specific situation here. If you predeceased your spouse and you were under full retirement age, the SSA gives you credit for full retirement age. So if you happen to pass away at age 65 and your full retirement age is age 67, 67 becomes the amount that your spouse received, haircut for their own age. But beyond age 67, the SSA will give you credit for the actual day that you passed. So if you passed at age 69, well, that is 116% of your full retirement age benefit. So your partner will get 116%, and assuming that she is also of full retirement age, that would be her payment, 116%. So the survivor benefit's a wonderful benefit. It's one of the only benefits in the Social Security options of benefits that I think people actually round up instead of round down when it comes to treating people the right way.
All right, Tim is asking, I'm retiring at the end of 2025 and turning 66 in 10 months, April 2026. I don't want to receive payments until then. Can I sign up for Social Security on SSI.gov site today for Social Security to be activated in April?
April, March, February, January, December. Yes, you can. So you're 4 months out. Wait until the actual day of your birth. Let's say the 20th. Then look on the website on December 20th. From whatever day of the month you were born onward, you should be able to sign up for your benefits.
All right. Jake is asking, I'm 10 years older than my wife and filed for Social Security at age 70. When my wife files for spousal benefits at her full retirement age, will her benefit be based on 50% of my primary insurance amount at my full retirement age with COLA applied, or on my current benefit amount that includes delayed retirement credits?
So the spousal benefit is based on your primary insurance amount and not your delayed credit amount. So in other words, right, if you file for Social Security at age 70, you get 124% of your primary insurance amount, and your partner doesn't get 50% of that. They get 50% of what you would have received at full retirement age, but that is adjusted for the annual COLA increases. And so if that was 5 years ago, you'd have 5 years worth of COLA increases. What your partner receives, though, is 50% based on their own primary insurance, their own full retirement age. So if your partner's full retirement age was age 67, even if you were 62, as long as you started collecting Social Security, if your partner was age 67, they would get 50% of your primary insurance amount. It's based on your partner's age, not on your age, but you do have to file first.
All right, we are rounding the top of the hour. We have 2 more minutes, so I think we still have time for a few more questions. Let's take Ron's question. He asked, if a spouse did not work long enough to qualify for their own Social Security benefit, when can they begin collecting spousal benefits, and how much of their spouse's benefit would they receive?
Yep. So I'm going to point to the upper right-hand corner of the screen, hollyschmidt.com/quick guide, completely free. My gift to you. Doesn't cost you a thing. You'll be put on our list and get tips, tricks, and other things as an added bonus. But one of the columns in there is what percentage of the primary insurance amount will your partner receive based on their age. And they can file as early as age 62, as long as you filed for your own primary insurance amount, and they'll get 32.5%. And that ratchets up all the way until age 67, full retirement age for them, their own full retirement age, and at which point they can get up to 50%, or they will get 50% of your primary insurance amount. The caveat is that you have to file first before they qualify for the spousal benefit.
All right. Should we try taking one more?
Sure. Lay it on me.
All right. Frank is asking, I delayed claiming Social Security until March 2025 when I turned 69, which was several years after my full retirement age. During my phone interview, I was told my monthly benefit would be about $50 higher if I started in March instead of January.
Mm-hmm.
However, when payments began, I received the January amount, not the higher March amount. I was later told this would be corrected in January 2026, but my new 2026 benefit only reflects the COLA increase and not the adjustment. Yeah. What am I missing, and why does it seem so difficult to get Social Security errors corrected?
Remember that comment I made about 30 minutes ago about the technology at the SSA, modernizing the SSA, well, that's happening now, but a lot of processes still need to be done by hand. The only thing I can tell you is just stay on them. It's not like they're going to forget, or it's not like you're not going to get the funds eventually retroactive, because that is due to you. But you do need to, number one, I would wait until January to see if the change actually happens. But if it doesn't, just stay on them. And that's the only thing you can do.
All right, we are at the top of the hour. In fact, we are 1 minute past. So out of respect for people's time, I am going to turn it back over to you, Geoff. But thank you so much, everyone, for your questions, for your emails, and for the chat box questions. We really enjoy taking all your questions.
Great, gang. So thank you so much for staying up with us. Jill, thank you for moderating this evening. And I really appreciate how you just cut right through the heart of the questions and get to what the question is. It makes things a lot easier. And gang, thank you for staying up. It's 8 o'clock here in New York, so it is time for a lot of us to wind down, including me. Next week, I will not be here because, well, I'm going to be away skiing for a few weeks, but check back with me in, I guess it's 3 weeks now, and we will see you on the channel then. In the meantime, we're going to just a brief preview of 2026. We are going to, at some point early on, add a second live stream. So right now we're on Tuesdays at 7 o'clock. That's pretty consistent. We're just working out the details on when that second one is going to be, but we want to make sure that we deliver for you. And the only way to do that is to make sure that we can get to you at least twice a week, because we know you have a lot of questions. We also know that we left some questions behind, and I'm sorry we couldn't get to them if yours was one of them. But if you wrote in a question, then it's on our list. If you didn't write in a question and you still want your question answered, send it to livestream@holyschmidt.com, and we'll make sure that that gets on the list and addressed. So if you're not able to watch the actual live stream next time, you can listen to the replay. With that, I think we're done. Jill?
Well, you know what? Also, just sending some great wishes for a healthy and happy new year, and hope everyone is enjoying their holiday season. We look forward to seeing you in January.
Have a great next couple of weeks, gang, and I'll see you.
Happy New Year, all.
Jill and I will see you when we get back. Take care, everybody. Bye now.